Hello everyone, welcome back to my channel. I'm your host Miss KK and this is The Wave. It is your weekly show that looks at topics related to personal, family and business finance. And our hope is that by the time we get to the end of these conversations, really, you are better equipped to make sound financial decisions. So today I'm back with yet another video and we are talking about the brewing crisis in the international banking sector. But before that, if you're new here, thank you very much. And if you're already a returning subscriber, an awesome appreciation. So if you haven't been watching the news, we've seen 3 banks in United States of America collapsing within the space of less than 7 days. And we've also seen near to collapse in Europe with Credit Suisse being bailed out by the central bank because they are considered too large to fail. So in this video, we are going to be looking at some of the high-level reason why these banking sectors or these banks failed within a short period of time, and whether we can expect this to have a ripple effect and potentially start a crisis similar to what happened in 2008. There is so much to discuss about these particular topics, and I'm going to try and make this video as brief as possible. So if you are looking for more details, there's a lot of content being currently created around this subject topic. So happy you can look out for other videos after watching this one. Right. In the United States of America, we saw Signature Bank, Silvergate, and Silicon Valley that collapsed. So let's start with Silvergate. So Silvergate was a bank that primarily dealt in the cryptocurrency space. And they basically, had customers that are speculating in the cryptocurrency space and also banking with them. So what they offered was mainly a fast payment method for their customers to convert their digital currency into fiat currency, which is the currency that me and you are currently using today. So for some odd reason, Silvergate found themselves in cash flow problems. They couldn't facilitate the transfer of this money from digital currency to fiat currency. And as a result, they had to close the bank because they can't, facilitate the payment. And that closure had a ripple effect of what happened to Signature Bank next. So Signature Bank didn't have the same model that Silvergate had. So Signature Bank had, a mix of business, and they only had corporate clients that dealt in the cryptocurrency. So think about it this way. You are banking with F&B, for example, and you are dealing in Forex, for example. So you go and make your money in the Forex market and you come and bank it with F&B. So Signature Bank was doing exactly the same. So they had large corporate clients that were speculating in the digital space, and they then converted their money into fiat currency and they banked their money with Signature Bank. So as soon as these corporate clients saw what happened to Silvergate, they started looking around what other exposure do they have with these types of conversion, and therefore realized that they wanted to pull their money out of Signature Bank before they found themselves in the similar situation that was happening to Silvergate. So what happened was what we call a run on the bank. Too many depositors come looking for their money at the same time, and the bank can't honor those requests. So you might think to yourself, why would a bank with so much $1 billion in assets struggle to meet only, less than 15% of their exposure? And if you think about how the banking system works, they take money from depositors. By law, they are only required to keep a small fraction of that money in cash. The rest, they are free to do whatever they want. They can on-lend it to customers, invest it, generate a return, and that's how banks make their profit. But if you then have a situation where you have large corporate clients coming at the same time wanting their money in cash, you may face a liquidity problem where you don't have enough liquid asset, i.e. cash, to make good this request, and therefore you start defaulting. And that's what happened to Signature Bank, and the bank was also closed down. So it really was sunk by the first closure. So now let's look at Silvergate. Not Silvergate, but Silicon Valley. All right. So Silicon Valley was in a very, very interesting space, which is really unlikely to believe that it actually did happen, but nonetheless. So they are a middle tier bank, and they funded venture capitalists that were funding, startup companies. So if you're dealing in the startup space, you are really, really taking risks because startups don't have much records for you to bank on. So you rely on the pitch and, and the founders of this business, what they are convincing you to fund them, and you hope to make a bigger return, because with higher risk, you are normally granted a bit of a bigger reward. And they mainly funded technological companies. And we find themselves in a situation where in 2020, 2021, when COVID hit, A lot of people were forced to transact online. As a result, these companies saw an increase in demand. As a result, they had a lot more money and they banked this money with Silicon Valley Bank. And Silicon Valley Bank found themselves sitting with this excess cash and had to decide what to do with this money. And the bank made various analysis and they realized, or they concluded, the best place to invest this money is in the bond, long-term treasury bonds, right? And if you understand how treasury bonds work, is that they are long-term assets. They normally offer a fixed return, which is called a coupon rate, and that is linked to the interest rate at the time of the issue. And we all know that in 2020, 2021, when the world was grappling with COVID, interest rates were at their all-time lowest. And what happened post that was the complete opposite. Countries started struggling with inflation and central banks were using interest rate as a means to control inflation. And because of that, interest rate rose at such a speedy pace, such that people that had long-term bonds found themselves in a trickier situation. So think about this way: the higher the interest rate, the lower the value of the bonds that are in issue. So a bond will give you a coupon rate of, for example, of 5%. And if you bought a bond in 2020, let's just say interest rate was 5% in 2020, and in 2023 now the interest rate is 7%. Now you tell me, why must I invest in a bond that is going to give me a 5% when I can get a new bond that will give me a coupon of 7%? So as a result, if you don't hold this bond to maturity and you try and sell it, you would have to sell them at a discount, because you need to convince someone to buy a bond that has a lower coupon rate when they can just easily go and buy a bond that has a higher coupon rate. They had these massive unrealized losses, and as soon as the financial statements were published, investors started seeing the exposure that they had, and also people started panicking again. There was a run on the bank, and the bank had to be forced to sell this bond at a lower price, meaning if I come back, I invested in $100, I want my $100 today, but the bank can only sell the bond at 80, meaning even if they were to sell the bond, they won't be able to pay me back. So as soon as too many people again start coming together asking for their money, their bank is struggling. So again, Silicon Valley Bank was also closed because of the fact that there was a run on the bank. But luckily, the Federal Reserve Bank, although they did let these banks to close down, or they did shut down these banks, they at least are trying to protect the depositors. They have gone to the the national insurance, whatever it's called in America, and that institute is trying to make every deposit whole. So they are guaranteeing that if you have the money in the bank as a depositor, you will be able to get your money out of the bank safely. And obviously there will be change in ownership, because someone needs to take over the bank and they need to change management, etc., etc. So depositors are protected, but unfortunately investors are not protected, lenders are not protected. They are exposed to whatever is remaining after the depositors have been paid their money. So that is what is currently happening. And obviously if you have equity in these businesses, because of the fact that the bank has closed down, there are losses, there are risks involved in it. The share price of both of these banks would then collapse, and you lose a lot of money in all these banks. So that's what happened to Signature Bank, Silvergate, and Silicon Valley. They weren't bailed out because they were not considered too big to fail, but the government stepped in to try and protect the depositors, because the depositors were just transacting. They were not taking really any risk by investing in the bank. Let's move on to Credit Suisse, which is the bank that nearly collapsed. So Credit Suisse was being sunk by a reputational damage, because they've been involved in a lot of dodgy dealings over the years, which has significantly hurt their reputation. They have been implicated and been fined by all sorts of scandals, including money laundering, covering monies for drug dealers, etc., etc. And it got to a point where the auditors issued a audit report that indicated that there's a material weaknesses in their internal control system in order to identify and prevent risk of material misstatement. The auditors are simply saying, your business is too shady, we don't know if it's up to scratch in order for you to pick up any irregularity that may happen within the bank. And obviously that's not a good thing for the investor. So as soon as that statement was out, again, there was a bit of shake in the system. And also their majority shareholder was asked if they are willing to increase any stake, any shareholder in this business, i.e. will they put in more money in this? And they said they are unable to put in money because of various regulatory concerns. And that also started hurting the bank's profit. And people also started losing confidence in the bank, and they were also starting to think, why should we do business with a big bank that is at risk of, reputational damage and potentially losing our money? So they would also want to stop doing business with such a bank and move their money to other banks that are a lot safer. But luckily for Credit Suisse, it is one of the only 30 banks in the world that had the status of G-SIB, which is Global Systematic Important Bank. Banks with such status are considered very important and integrated in the banking sector as a whole, and therefore they are considered too large to fail. So regulators and authorities in that country would try by all means to inject in capital that is needed to rectify whatever it is going wrong, to try and bring it back on track, because if it were to collapse like the other small banks, it will have a ripple effect of, in the international market, and that always have unintended consequences. So Credit Suisse was bailed out. However, they still need to deal with the root cause analysis of the situation. The bailout was only to give them temporary relief. So we should watch what happened to Credit Suisse over the next couple of days closely, because that could make or break whatever happens. So that's what happened to these 4 banks in a nutshell. So the biggest fear, though, why I'm bringing this video is because people are thinking this is similar to what happened in 2008, and small banks started collapsing, and before we knew it, there was a lot more bank closures happening. And the main reason that was sinking banks in 2008 was complicated financial instruments that were created that banks invested in, and in particular derivatives. Derivatives are almost like speculative instruments. So for example, let's say someone is farming into maize. You gamble that in 3 months' time, when the maize is ready for harvest, you think the price is going to be this much. You bet on that. You create a financial instrument. Someone invests in that, and things like that. So they do this instrument made up sort of like assets that are linked to prices of commodities, etc., etc. It's a bit too hard to put in layman's terms, but that's what was happening. So the instruments were so intertwined in the banking system such that it was very difficult to identify. But that is completely different to where we are finding ourselves in this bank crisis of what's currently happening. So in as much as it's likely to have a ripple effect onto other banks, it's not really similar with what happened in 2008. But the question is, just like Silvergate nearly or almost sank Signature Bank, or actually did sink Signature Bank, are the other banks exposed in a similar manner? And the answer is likely to be yes. There is a lot of banks that are doing business similar to Silvergate, similar to Signature Bank, and therefore we don't think this is actually isolated to these banks only. And also, Silicon Valley Bank is probably not the only bank that is exposed to interest rate risk. A lot of countries in the world have hiked up interest rate at such a speedy rate, so it doesn't surprise us that there might be a lot of banks that have invested in government bonds, and now these bonds are worthless because interest rates are higher. So we can expect to see other banks, maybe not at a steep rate that we saw 3 banks collapsing in 1 week. We could see other fallout, but maybe not as at a higher magnitude like what we saw over the last couple of days. And with regards to Credit Suisse, remember there are only 30 banks in the world that are globally systematic important banks. So other small banks that may find themselves in situation like Silvergate or Signature Bank or Silicon Valley may actually also be allowed to close down because they're not considered that important, and therefore we can expect more. And most importantly is, what would happen and what would this mean for Africa? Do we expect this spill over to come over to the African continent? To the extent that African banks are heavily invested into bonds, to the extent that they also find themselves in liquidity problems and their government don't consider them too big to fail, we could expect similarity. But more importantly is, if there is a crisis in the international market, it means that there is less confidence, less investors' confidence, and there's also less money flowing in the international market. That might reduce demand for African export. That might reduce, foreign direct investments for the African continent, and that might also reduce the flow of funds in terms of grants. So somehow, someway, we will expect to somewhat struggle, even if we don't struggle at the same magnitude. So, in a nutshell, that is really what's happening in the banking sector. I don't think you should be alarmed at that rate as yet, but I also don't think you can afford to be ignorant about these things. If you ask me what happened in 2008, I don't know, because I was 16 at the time, but now we are adults with households. Now we are people with home loans and car loans that are linked to interest rates. Now we are managers in companies that take loans out. Now we may be sitting at board of directors trying to make investment decisions for companies. So we ought to be aware about these things so that we can then use the macroeconomic factors that is happening around the world in informing the decisions that we are making locally. With that being said, this is all I had to discuss in this video. I know there is a lot to talk about. I can go on and on about this crisis, but until then, it's goodbye, and catch up on other videos that are being done on the subject matter. If you haven't done so, please don't forget to like, subscribe, and give this video a thumbs up, as well as share it with your friends and family. Until next time, it is goodbye.